Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We will also share our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up by 3.1% for the month ended June 2025. The Nifty Mid-Cap 150 index was up by 4.1%, whereas the Nifty Small-Cap 250 index was up by 5.7% in June 2025. Sector-wise, Nifty Infrastructure 4.9%, Nifty IT 4.4%, and Nifty India Consumption 4.0% were the top-performing indices, whereas Nifty FMCG minus 0.7%, Nifty Energy 1.9%, and Nifty PSE 2.3% were the laggards. Global indices ended the month of June 2025. On a mixed note, Dow Jones was up by 4.3%. Nasdaq was up by 6.6%, while Financial Times Stock Exchange 100 was down by minus 0.1%. The India Volatility Index, VIX, saw decline in June 2025. It was at 12.79 compared to 16.08 in the previous month, down by 20.5%. The Chicago Board Option Exchange, CBOE, Volatility Index too saw a decline in the month of June 2025 and was at 16.73 as against 18.57 on the previous month, down by 9.9%. Foreign institutional investor FII were net buyers for the month of June 2025. Net FII inflows were rupees 20,424 crores. Domestic institutional investor DII bought stocks worth rupees 72,674 crores, whereas mutual funds were net buyers worth rupees 45,519 crores. Nifty 50 forward PE trading above mean PE. Indian equity markets continued with a risk-on trade. Small caps outperformed mid-caps and large caps. Global volatility was shrugged off. During the month, there was escalation in the Iran-Israel war. The USA also briefly entered the war, which caused anxious moments in the market and spiked oil prices. Fears about trade routes being closed also escalated market volatility. As of now, there is some calm and markets have rebounded. Global growth outlook remains challenging. There is limited clarity on U.S. tariffs and its impact on the U.S. economy and global growth. In June 2025 meeting, the U.S. FOMC, Federal Open Market Committee, decided to keep the federal funds rate unchanged at 4.25% to 4.50%. Growth in the U.S. has broadly remained resilient, with labor market not showing signs of extreme stress. However, recent indicators show some signs of moderation in consumer spending, with heightened uncertainty about the economic outlook. On the other hand, inflationary pressures persist and could heighten in the coming months, as proposed policies by President Donald Trump could further hamper the disinflationary process. These factors on growth and inflation could make future policy decisions difficult. Though U.S. Treasury yields have remained elevated due to higher expected fiscal burden under Mr. Donald Trump's administration, some signs of growth moderation have led to marginal softening in yields in the recent weeks. In the event of a sharper than expected slowdown, there is a possibility that the U.S. Federal Reserve could cut rates, helping growth outlook. RBI's ample liquidity push, revival in growth likely. In a surprise move, the Monetary Policy Committee, MPC, of the RBI voted for an unexpected policy rate cut of 50 basis points in its recent meeting held in June 2025, thus bringing down the policy repo rate from 6.0% to 5.5%. Along with policy repo rate cut, the RBI announced 100 basis points cut in cash reserve ratio, CRR, in 4 tranches of 25 basis points, each starting from September 6, 2025 till November 29, 2025, which is expected to infuse liquidity worth rupees 2.5 lakh crore by December 2025. RBI Monetary Policy Committee, however, decided to change its stance from neutral to accommodative, citing limited space for further easing. The new RBI governor, Mr. Sanjay Malhotra, has been perceived to have a policy approach that is more focused on growth. Since February 2025, the RBI has cut policy repo rate by a cumulative 100 basis points, in a move to support the slowing economy while inflation has shown promising signs of downward movement. The rationale behind such a policy can be explained by the need for improved monetary transmission to commercial banks, such that cheaper credit is available for businesses to boost private capital expenditure. The governor emphasized the role of other liquidity-boosting measures such as open market operations, OMOs, and the US dollar per Indian rupees buy-sell swaps, which have injected liquidity to the tune of rupees 7.38 lakh crore, with an expected liquidity boost of rupees 2.5 lakh crore from the cash reserve ratio CRR cut. A total liquidity of around rupees 10 lakh crore shall be infused in the economy by December 2025. On the inflation side, the Consumer Price Index, CPI inflation, stood at 2.82% in May 2025, lowest reading in the last 78 months. For the past few months, retail inflation has consistently stayed below the RBI's target of 4.0%, aided by sharp correction in the prices of food components, especially vegetables. Vegetables, along with pulses and spices, have noted deflation for some months now. Sharp disinflationary trend in cereals has further supported the decline in the headline CPI readings. While headline inflation reading has stayed benign, core inflation has noted a marginal increase led by rise in prices of gold and silver, which have sharply reacted to global macroeconomic uncertainties. The RBI governor has shown greater confidence with respect to the disinflation process, and thus has revised the fiscal year 2026 inflation projection lower from 4.0% to 3.7%. The RBI expects the inflation to remain below the target of 4.0% between Q1 fiscal year 26 and Q3 fiscal year 2026, before rising to 4.4% in Q4 fiscal year 2026. Central government capex has seen considerable improvement in the first 2 months of the current financial year. Consumption at an aggregate level is showing signs of improvement. The momentum is expected to continue as lower income tax rates and benign inflation improve household budgets. With a good monsoon, we expect rural household incomes to revive and grow. With improved liquidity infused by RBI and lower interest rates, this demand momentum can continue. Corporate earnings growth is recovering, and this trend is expected to continue as the demand scenario improves and lower input costs help expand margins. It is expected to lower interest costs to benefit the profit growth. As it can be seen from the chart above, yield gap between the equity market versus the 10-year G-Sec is at an attractive level, indicating that growth will resume. We are constructive on equities and expect consumption and domestic-facing economy to revive. Further, it is expected that FII flows to continue to remain positive for the rest of the year, which will help support markets. As fears recede due to the recent wars and tariff issues, it is expected that a period of stability to resume, which is positive for equities.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.